This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Hello, listeners, and welcome to the IUX podcast, a part of Trade Alive, brought to you by IUX Education and IUX Trading Platform. We help you explore the lives, lessons, and legacies of the world's greatest traders. Volatility. It is the bloodline of the financial markets. Let's be entirely honest with each other. Without movement, there is no opportunity. If the markets were perfectly flat, perfectly predictable, and perfectly safe, none of us would make a dime. We need the chaos. We need the storms. But as any professional trader's guide to managing risk will emphasize, there is a massive difference between desiring volatility and respecting it. Volatile markets are inherently violently unpredictable. They are famous for producing deep, gut-wrenching pullbacks. They create false breakouts that lure you in only to trap you. They generate erratic price swings that can easily and quickly exceed normal historical ranges. Now, I want you to picture an unseasoned trader. Let's call him Mark. Mark has been watching a stock all morning. The chart looks perfect. The indicators are aligned. Mark decides it's time to buy. What does Mark do? He clicks buy. He executes his entire position, 100% of his allocated capital for that trade, at one single price point. This is what we call the all-or-nothing entry approach, and it is the most common and most destructive mistake made by retail participants today. Think about the psychology of what Mark just did. By entering a full position at a single price point in a turbulent market, Mark has left his portfolio entirely exposed to immediate aggressive drawdowns. If the market drops just a few cents, Mark is instantly in the red. His anxiety spikes. His heart rate elevates. He is now emotionally compromised. In highly volatile conditions, standard stop losses are easily triggered by normal market noise. Mark gets stopped out, takes a massive loss, and then watches the market reverse and go exactly where he predicted. He was right about the direction, but he was completely destroyed by the volatility. To navigate these treacherous waters, you don't need a better indicator. You need a paradigm shift in execution. Instead of viewing an entry as a single terrifying event, a single pull of the trigger, it must be viewed as a process. This is the absolute foundation of the scaling into trade strategy used by elite professional traders. Scaling in is the systematic method of entering a position in fractions or tranches over time or across different price levels. It is a defensive maneuver, a shield. It is designed to smooth out your average entry price, mitigate the devastating risk of being entirely wrong at the absolute worst moment, and drastically reduce the psychological burden of market noise. By adjusting your total exposure to match the market's current volatility profile, this analytical approach transforms market volatility from a paralyzing threat into a manageable, structured variable. Today, we are going to teach you exactly how to do it. Welcome to the mechanics of survival. Implementing an advanced scaling strategy is not about randomly clicking the buy button as the price goes down. It requires strict mathematical discipline and a deep fundamental understanding of dynamic position sizing methods. Scaling is a weapon of precision, not an excuse for sloppy trading. The core mechanism of scaling starts with breaking down a predetermined total position size into smaller, manageable units. To do this safely, professionals rely on a fixed fractional risk model. The golden rule in institutional trading is often risking a maximum of 1% of your total account portfolio on any single trade idea. If you have a $100,000 account, your absolute maximum risk, the amount of money you are willing to lose if the trade completely fails, is $1,000. Amateurs take that entire $1,000 risk limit and blow it on one single entry point. Professionals take that $1,000 risk limit and slice it into pieces. A common institutional framework is the 20-30-50 rule, or sometimes the 30-30-40 rule. Let's map out the 20-30-50 rule. Imagine you want to buy a stock and your total risk budget is that 1% or $1,000. You don't risk the full 1% on your first click. Instead, at your initial technical level, you deploy just 20% of your risk budget. That's a $200 risk. We call this a feeler or probe position. You're testing the waters. If the volatile market immediately takes off in your favor, great, you're in the trade, albeit with a smaller size, but you're making money with zero stress. But what if the market drops? What if that volatility creates a deep pullback? Because you only risked $200, you're not panicking, you're calm. The market dips lower into a secondary support zone. At this point, you deploy the next tranche, 30% of your risk budget, or $300. If the market drops even further into an extreme capitulation zone, the absolute best price you could hope for, you deploy your final tranche, the remaining 50%, or $500. You have now built a massive, optimized position at a phenomenal average price, and you have never, at any point, exceeded your strict 1% maximum risk threshold. But how do you know where to place these tranches? This is where modern advanced approaches integrate something called volatility-based sizing. The most powerful tool for this is the ATR, or the average true range. The ATR tells you exactly how much an asset moves on average over a given time frame. It measures the breathing room of the market. Let's say a stock is trading at $100 and its daily ATR is $5. That means it's completely normal for this stock to swing up or down by $5. It's just market noise. If you place your entries and your stop losses $1 or $2 away from the current price, you're going to get crushed by normal breathing. You're suffocating the trade. Instead, a professional uses the ATR mathematically. They might place their first 20% tranche at $100. They mathematically calculate their second 30% tranche to sit one full ATR below at $95, and their final 50% tranche another ATR below at $90. By spacing out your entries using the ATR rather than guesswork, you ensure that normal volatility cannot shake you out. You're using the market's own erratic energy to build a better average entry price. Now, I need you to listen to me very carefully. A critical life or death distinction must be made right now. We need to talk about the difference between professional scaling and the absolute most destructive habit in trading, averaging down. To an untrained eye, they look the same. Both involve buying more as the price goes lower. But psychologically and mathematically, they're total opposites. Averaging down is a disease born of ego and fear. It happens when an amateur enters a full position, the trade goes against them, and they're suddenly trapped in a massive loss. They didn't plan for this. Driven by emotional hope, denial, and the refusal to admit they were wrong, they decide to buy more at the lower price to lower their average. They do this without a pre-planned risk limit. They're throwing good money after bad, praying for a bounce. This is how traders blow up their entire life savings in a single afternoon. Scaling in, conversely, is an entirely premeditated technique. It is mapped out in cold blood before the market even opens. When you scale in, the maximum position size, the exact fractional tranches, and the absolute unbreakable stop loss for the entire block of trades are defined before the first execution. If the price breaches your absolute invalidation level, let's say $85 in our previous example, all tranches are cut simultaneously. No questions asked, no hoping, no praying. You take the 1% loss and you move on, knowing the drawdown was strictly contained by your initial math. Scaling is a shield. Averaging down is a sword you fall on. Finally, let's talk about offense. Scaling isn't just for catching falling knives, it's for riding massive trends. This advanced application is called pyramiding. Pyramiding is a quantitative form of scaling, where a trader only adds to a position as it moves in their favor. It's the ultimate weapon for trend followers. Imagine a highly volatile, aggressive uptrend. You don't want to buy the top, but you don't want to miss the move. So you take an initial small position to test the current market regime. As the market confirms the trend's strength and breaks through resistance levels, you add subsequent fractional positions. You buy more because you're right. This method ensures that you only commit your maximum capital when the market has statistically proven your underlying thesis to be correct. But here's the secret sauce. With each new tranche you add, you adjust your stop loss upward. You use a trailing stop. By pulling your stop loss up as you add size, you effectively neutralize the overall risk. Even though your position size is growing massive, your capital at risk shrinks to zero because your stop loss is now locked in profit. This allows traders to maximize their returns during monstrous market movements while fiercely, ruthlessly protecting their initial capital base. It's the holy grail of asymmetric risk to reward. Let's bring this all together. Deploying a scaling into trade strategy is not just a neat trick. For professional traders, it is a fundamental, non-negotiable mechanism for surviving and exploiting volatility. It is not merely a tactic designed to maximize raw profit. It is a sophisticated risk management framework built on strict, unbreakable mathematical discipline. By entering the market in premeditated, fractional tranches, you are making a powerful psychological admission. You are acknowledging the mathematical impossibility of consistently predicting the exact bottom or the exact top of an erratic price swing. You're letting go of your ego. Scaling transforms a binary, anxiety-inducing all-in decision into a dynamic, methodical, and calm process. Whether you're utilizing a pre-planned support tier model backed by volatility-based sizing, like using the average true range to optimize your entry price safely, or whether you're employing a quantitative pyramiding structure to capitalize on a confirmed, raging trend, the core principle remains exactly the same. Capital is deployed strategically. It is never, ever deployed impulsively. This systematic approach is the definitive line in the sand. It distinctly separates professional execution from the destructive, emotional, and amateur habit of averaging down. Mastering this technique allows you, the market participant, to maintain objective clarity when everyone else is losing their minds. It ensures that your portfolio is protected from immediate, aggressive drawdowns. It ensures that volatile price action is met with calculated precision rather than emotional reactivity. Volatility is no longer your enemy. It is the engine that drives your carefully structured machine. I want you to look at your trading plan today. Are you an all-or-nothing trader? Are you stepping in front of volatile trains hoping you guessed the exact millimeter they'll stop? If so, it is time to change your execution paradigm. It is time to start thinking in fractions. It is time to start scaling. If this episode gave you valuable insight, you can click like, subscribe, and share it with another trader who might need this reminder. In the next episode, we'll dive even deeper and explore more. Thank you for listening. Stay disciplined, respect the volatility, and see you in the next episode. Goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.